Germany is setting up a national investment fund to kickstart growth here. Europe's largest economy has barely expanded since the coronavirus pandemic, and another recession is looming. Energy-intensive industries such as chemicals have been especially hard hit, and the cornerstone German car industry is facing intense competition from China. Now, the economy minister, Robert Habeck, says the tax system will also be reformed.
I propose introducing a new instrument here in Germany, an investment bonus. 10% of an investment will be reimbursed through tax credits. And even if someone does not pay taxes, if it is a small enterprise, a young company, a startup, then there will still be a reimbursement via the tax system. So 10% of investment, and in addition to that, all the other deductions that are already possible here in Germany.
All right, let's get more now from our political correspondent, Giulia Saudelli. Giulia, it's good to see you. You know, we're used to hearing about big funds with this German government. Explain to us how the investment fund will work this time.
Well, we need to clarify from the beginning that this is not a law proposal or anything concrete. This is just a suggestion that is being made by Germany's economy minister, a suggestion that has not yet been discussed even with the rest of the government. So this is an initiative coming from the economy minister and the economy ministry. And as we've heard, this investment fund would directly be linked to tax rebates. 10% of any investment money that a company would put forward would then be reimbursed and deducted from a company's taxes. And if the tax burden of the company were to be lower than that, the government would reimburse this money directly to the company. Now, because this is just a proposal from the minister, we haven't heard from Habeck any specific numbers on how big this investment fund would be. But we have heard that this, based on calculations from the Federation of German Industry, this would amount probably to hundreds of billions of euros over the coming years. So definitely a big amount of money being discussed here.
Yeah, we're talking about Germany having to borrow money. We know that German governments tend to be allergic to taking out more debt. Will this be a problem for the current government?
It's not just that governments are allergic to more debt. There is a clause in the German constitution that limits the government's ability to take on new debt. So the governments are actually constrained. Now, Habeck has said he believes that a fund like this could go ahead even without having to tackle the issue of the so-called debt break. But this is a contentious issue within the government. There are Habeck's Green Party, for example, or the Chancellor's Social Democrats who say they would actually like to make the debt break less stringent, to be able to modify the debt break to allow for more debt to be taken on. But the third coalition partner, the fiscally conservative FDP, they absolutely do not want to touch the rules on the debt break. They want to keep government spending to a minimum, as little as they can. And so this opens a whole can of worms when the big investment topics come up and are raised within the German government.
Our political correspondent, Giulia Saudelli, talking about investments and debt tonight. Giulia, thank you.
Let's examine this with Peter Bofinger, who is a professor of economics at Germany's University of Würzburg. Welcome to DW, Professor. First off, can you paint us a picture of the current state of the German economy?
Yeah, the picture of the German economy is rather bleak. It was already said the International Monetary Fund has a forecast for this year of 0.0%, so that Germany is the only major economy with no growth. And the problem is more deep-seated, since we can see that the German economy is virtually stagnating since 2019. And so one can even speak of the sick man in Europe, as the Economist has done it last year. And the question is, where does it come from? And it was already said, Germany has a problem with its business model. This business model was really successful for decades and is focused on three concentric circles: exports, manufacturing, automotive. And all these circles are now confronted with major challenges. Export is confronted with protectionism. industry, manufacturing is confronted with high energy prices and decarbonization. And it was already said, our car industry is really suffering from the fierce competition with Chinese cars, and we cannot really withstand this competition right now.
And so what do you make then of the economy minister's proposal? Do you think that they would spur economic growth?
I think anything which helps our companies to transform their businesses in the direction of digitalization and more energy efficient production is helpful. And I also think this 10% investment premium is a good idea. I think we would also need more focused subsidies on new technologies. And of course, our infrastructure is in a very bad state, which also requires a lot of money.
At the moment, this is just a proposal. What options will the government have to boost growth if the coalition government rejects it?
I think under the current regime, there's almost no money available for supporting our economy in this transformation process. You can see there was an investment initiative by the government decided this year, and the sums that were available are really of a homeopathic size, 0.1 per thousand of German GDP. So under the current regime, there's almost nothing you can do to heal this sick man in Europe.
Tell us about the debt brake, because Robert Habeck's proposal would see Germany taking on debt, but there's a piece of legislation called the debt brake that limits the country's ability to borrow. So is that a hindrance to growth, or is it an anchor of stability?
No, I think it's definitively a hindrance to growth, because what the debt brake, which is enshrined in our constitution, what it prescribes is that all government investment must be paid out of current revenue. And that's totally absurd. In other words, the debt brake prevents the government from using the capital market in order to finance longer-term investments, which are very productive in the case of Germany, and which are at very low interest rates at the same time.
Thank you so much for talking us through that, Professor. Professor Peter Bofinger from the University of Würzburg.
Thank you.